We're going to go over 2 ways to pay less in taxes without breaking the law. One of the pieces of advice that I first got when I was asking mentors and family members about what I should start investing in or what account should I use, one of the things that they gave me advice to do is to open an IRA. I didn't even know what an IRA was. Turns out IRA stands for an individual retirement account. The reason they gave me was that it was a way to pay fewer taxes and to let money grow tax-free. As it would turn out, IRA is not just one type of account, so it's actually the category of accounts. So within individual retirement accounts, there are multiple types. The most common type is a traditional IRA, and the second most common type is a Roth IRA, which is a slightly newer financial product. It was named after U.S. Senator William Roth. I'll share what I've learned, as well as which accounts you should be paying attention to based on your employment type and income level. The type of IRA I use is called a Roth IRA. Roth IRA is typically more flexible than other types of IRAs. This is because the Roth designation allows you to make withdrawals before retirement age. As of June 2022, I believe this was 59 and a half. But how do you use a Roth IRA if you're younger than 59 and a half? If you've had the Roth IRA for over 5 years from your first deposit, you should be able to avoid tax on earnings. So this is any growth in the portfolio. You invest $100, it grows into $200. That would be $100 capital gain, and you can take that out tax-free. So to be able to do that, you need to A, have had the account for at least 5 years from your first deposit date. B, use the withdrawal for a first-time home purchase. That's up to $10,000. C, pay for qualified education expenses. That could be textbooks or tuition. D, use the withdrawal to pay for qualified birth or adoption expenses. E, use the money to pay for unreimbursed medical expenses or health insurance if you're unemployed. You can also make withdrawals if the distribution is made in equal periodic payments or if you become disabled and pass away. You can also withdraw up to your principal amount tax-free, again, so long as that 5-year threshold is met. I'm going to throw a link in the description for more on withdrawal rules. I'll also throw a link to the article on my blog, and that'll have links within it as well. The really cool part, if you're under 59 and a half, and have a Roth IRA, is that you may also be able to avoid penalties if you're, again, a first-time home buyer. Use it for those qualified birth or adoption expenses. Use it to pay for medical expenses or health insurance if unemployed. If the distribution is made in equal periodic payments, and then, again, this is only if the account has been open for at least 5 years, or if you become disabled and pass away, then money can be withdrawn tax-free as well. That said, if you're under 59 and a half, you should probably avoid taking money out of your Roth IRA before you're 59 and a half in general, or before your account is 5 years old. The exceptions to that are the ones listed above, where you might have a medical expense, you might have tuition you want to pay, you might be a first-time home buyer. That one is limited to 10K withdrawal. Another thing to note is that your earnings may also be taxed at your current income if you don't hit those requirements, and you may be additionally penalized. So usually it's something like an additional 10% penalty on top of the income tax that you have to pay. As of 2023, you can now contribute up to $6,500 into your Roth IRA every tax year. You should be under $138,000 in modified adjusted gross income. That just means it's your income minus whatever your tax deductible expenses are. So it could be business expenses, HSA, education, alimony, self-employment expenses as well. So this could be broken up as to, like, you could put 3.5K into a traditional IRA, and then you could do the remainder into a Roth IRA, just making sure not to exceed 6.5K for the tax year of 2023. If you're somewhere between 138 and 153, then there's basically a phase out of how much you can contribute to that Roth IRA before you have to switch completely to a traditional IRA. Once you're over $153,000 in modified adjusted gross income, then everything needs to be going into traditional IRA. You can no longer contribute to a Roth. There is a maneuver called the backdoor Roth IRA, but we'll cover that in a different video. So this basically allows people making above that threshold to make deposits into a traditional IRA and then convert that into a Roth IRA. Quick overview of the rules if you're older than 59 and a half. So if you withdraw money before the 5-year holding requirement, your earnings, that meaning the money that you've made above your principals, that will be subject to short or long-term capital gains, but there will be no penalties. If you're of retirement age, you can basically use it like a brokerage account if it's under 5 years old. There are also no required minimums on distributions with Roth IRAs, unlike traditional IRAs, which there are minimum distributions If you withdraw after the 5-year holding requirement, then you can take money out of the Roth IRA with no taxes or penalties at all. Something to keep in mind is that even if you make over the income limit for a Roth IRA, again, you can perform that backdoor Roth conversion, where you basically transfer money out of your traditional IRA into a Roth IRA, and we'll cover that in more detail in another post. So right now I'm going to throw a couple tables up on the screen. These are from Charles Schwab, so they basically go through for tax year 2022 and tax year 2023 what the distribution limits are. Even if you haven't put any money at all in your Roth IRA over the past year and change, you can still max it out. Switching to the tax year 2023 now, you can see that a lot of the limits went up. If you're under 50, you can now contribute up to $6,500, basically from January 1st of 2023 for 2023 through tax day of 2024. This chart, basically everything went up contribution limit wise about $500. For single filers, the income limits went, I think, from $129,000 all the way up to $138,000. And then if you're married filing jointly, it went from $204,000 up to $218,000. And again, both of those phase out once you hit that bottom row of the table. And at that point, you'll want to be contributing pretty much entirely to a traditional IRA. Just a reminder that this is not personal financial advice, nor should it be considered financial advice. You can go to many good resources. Everybody's situation is different. And so what you read on the internet, maybe you shouldn't take it as personal financial advice. I don't know your financial situation. The people who write these articles also don't know your financial situation. Everybody is very unique in their financial footprint, so tread with caution. One thing that I do want to add on to the end of this video is when I was talking with a friend, it became clear that it's not always clear what to do with the money once it's in an IRA account. They initially thought that all you had to do was take money from paycheck and deposit it into account and then it'll just grow. This is not the case. So basically once you have money in that account, it's a little bit like putting money into a checking account, right? It's just going to sit. So you need to use the money in that account to go and buy securities. You can buy stocks, you can buy bonds, you can buy ETFs, you can buy index funds, you can buy mutual funds, you can buy all sorts of stuff. In a lot of cases, you can buy commodities. If you're not sure what a lot of those were, like stocks, bonds, or other securities or ETFs and index funds, then feel free to check out the intro to investing video. If you just want to have cash and you don't want to buy securities, find a high yield savings account where you can at least earn a few percent in interest every year. If you're interested in learning more or signing up for an IRA, I'm going to drop a link to the platform that I use, Charles Schwab. This is not sponsored, be very clear about that. If they have a really good Roth IRA product that I use. Fidelity, I'll also drop a link below. Pretty similar platform, pretty similar functionality, generally pretty low fees on both, if any at all, for conducting trades. You can also read more about a traditional IRA in one of my future blog posts. So if you're interested in subscribing to the newsletter, please do that down below. If you're on YouTube, please don't forget to like, comment, subscribe, smash the like button, and turn on the notification bell so you don't miss another video.